Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/rive to receive the top 10 stocks to buy right now. 3M reported earnings this week, and there wasn't a lot to like for investors, and the company announced a major layoff to not only manufacturing but also engineering staff. And the company announced a major layoff of about 6,000 people. So that's going to be a huge cut in the company's workforce. There's a lot of tech companies cutting jobs right now, but 3M is not really a technology company. It's more of a manufacturing company. So what exactly is going on here? I actually worked for 3M for a long time, started over 20 years ago. And so I'll give a little bit of background in what has happened over the last few decades at that company and why we're starting to see slowing growth that has really been 20 years in the making. My name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And I want to just start with the earnings release. I'll just go through the basic numbers here. Earnings per share, whether on a GAAP basis or on an adjusted basis, down sharply from a year ago. And margins are down really significantly as well on an operating basis. So this is really what investors are concerned about, is that sales were down 9% year over year, and organic sales were down 4.9%. That's just an incredible drop. So 3M is starting to sell some of the businesses that maybe aren't part of the core operation, but they're still not able to grow the businesses that they're keeping. And that's what I think is really shocking. I'll go to the presentation because 3M has such a big, broad business that they basically break them down into a few components. This is the layoff announcement: 6,000 roles, expected to improve operating income $700 to $900 million. Now, if your sales are falling, I don't know how much that operating income savings is going to get you if you're not able to drive further growth, but that's the logic there. Here's where we start to see the real problems. Adjusted organic growth, negative 5.6%. Operating margins, just 17.9%. But if we break this down to the company's business group performance, and this is broken down into safety and industrial, transportation and electronics, healthcare, and consumer, this is really where you start to see where the problems are incurred. Safety and industrial, this is where a lot of the PPE that was sold during the pandemic was coming from. So even if there was weakness in the company's operations, it was masked by selling a ton of respirators. And that was a huge business for 3M, really a tailwind over the last few years. And that's really reversed itself. And the company exited Russia in 2022. A couple of big headwinds there for 3M, but there were also declines in industrial adhesives and tapes and closure and masking systems. So not a lot of good news out of safety and industrial. If we go down to transportation and electronics, things are even worse. This is where a lot of the cost cutting going on in Silicon Valley is starting to impact a company like 3M. So 3M makes a lot of components that go into electronics. They don't make necessarily the electronics itself, but thin films, tapes, all kinds of things that you may not consider in an electronic device is actually made by 3M. And this is where their demand is just falling through the floor. You can see here that they said consumer electronics softness continues. There's weak demand for smartphones, tablets, TVs. And this is both weakness from an end user standpoint and manufacturers and operators trying to cut their own inventories and save cash. So it's basically a double whammy for a company like 3M, but just not a lot of good news there in transportation and electronics. Healthcare is the one business that continues to do relatively well. Organic growth up 1.4%. That's not a lot, but at least it's something that 3M can fall back on. And then the consumer business, this is where products like Post-it notes sit. Negative 6.8% organic growth. There's a slight increase in office and stationery and improvement in home improvement, but 3M is not selling to the end customer. So this is the big piece here. Retailers aggressively reduced inventory levels. So even if consumer demand stays flat, if retailers are reducing their inventory, 3M is going to see less demand for its products. So all of this hit this quarter, and management's response was to try to cut costs. But here's where I think we need to think about a company like 3M more holistically. This is a technology and manufacturing company, and 3M is typically driven by big technology shifts. So they come out with the Post-it note, and that drives growth for 20 years. They come out with brightness enhancement films, that drives growth for 20 years. Scotch Guard, Scotch tape, sandpaper, these were all big fundamental shifts in 3M's growth trajectory, and it was driven by investments the company was making in research and development. The challenge with cutting operating costs like this is that you're reducing the pipeline for R&D and new products in the future. We saw this in the early 2000s when Jim McNerney was the CEO, and I think what we're ultimately seeing here is really the fruit or lack of fruit from cuts in investments that were made early in the 2000s and then during the Great Recession. Because if you're focusing entirely on efficiency at a company like 3M, that means you're not making the next generation of products that are going to drive growth. And that's historically what the company has been built on. The other thing to kind of clue you in on is there's a certain level of operating expense that goes into just maintaining the products that exist. 3M makes about 50,000 different products. Well, those products have to have labels updated. They have to have chemicals updated as regulations change. There's all kinds of costs that go into just operating the business on a day-to-day basis. So if you're cutting operating expenses, you have to either cut products that you're working on, the number of products that you're working on, or cut the number of new projects that you're working on. So again, you're not investing enough in future growth. And this is something we've seen over and over again at 3M. I think we're just seeing that manifest even further. And what I would worry about as an investor is that the cost cuts that they're putting in place now are going to hurt future growth even more. So it's going to just continue to deteriorate the company's position. That's why this is an earnings report that I think looked bad, but is actually worse if you're a long-term investor. But what did you think about 3M's report? Love to hear your comments in the comment section below. Don't forget to subscribe to Rive Investing. Thanks for watching, everybody. I'll see you here next time.